London market, dead. HSBC, $347 emergency. Board directive, exit 7.3 billion ounces. By January 31st, LBMA, over. Stop everything you're doing right now. What I'm holding in my hands is not just a leaked document, it's the death certificate of the London silver market, dated January 9th, 2026, 11:43 p.m. Greenwich Mean Time. HSBC Holdings Board Directive, marked strictly confidential, board eyes only. 7 words that will end 150 years of London's dominance. 7 words that prove the LBMA is a fraud. London silver market, no longer viable. Exit immediately. 21 days to cover. 7.3 billion ounces. Price target upon completion, $347 per ounce. But here's what they're not telling you. Welcome to Currency Archive, where we bring you the financial warnings Wall Street doesn't want you to hear. Now, before I reveal what's inside this explosive directive, if you're someone who values their financial future, someone who remembers when a handshake meant something, when truth in banking actually mattered, do me a favor. Hit that subscribe button right now, because what I'm about to share could be the most important financial intelligence you'll receive this decade. And tell me in the comments, where are you watching this from today? New York, London, Sydney, Mumbai? I want to know where my fellow truth seekers are standing guard. Because what happens in the next 21 days will reshape the global silver market forever. Now, let me show you exactly what HSBC is hiding. On January 9th, 2026, at exactly 11:43 p.m. Greenwich Mean Time, something unprecedented happened in the heart of London's financial district. A board directive from HSBC Holdings was leaked to precious metals traders across the city. The document, marked strictly confidential, board eyes only, contained information so explosive that veteran traders who read it couldn't believe their eyes. This wasn't just another corporate memo. This was a confession, a surrender, a complete admission that the London silver market, the very foundation of global precious metals, trading for over 150 years, was finished. The directive came from HSBC Holdings, the banking giant that essentially built the London Bullion Market Association, the institution that clears 65% of all LBMA silver trades, the bank that holds more silver short positions than any other institution except JP Morgan. And in this 8-page emergency document, HSBC's board of directors admitted something they never thought they'd have to say. The London silver market is no longer viable. They must exit immediately. But here's where it gets truly shocking. The directive didn't just say HSBC was leaving the silver market. It laid out the complete exit strategy, the timeline, the catastrophic costs, and most importantly, the price target. HSBC must close 7.3 billion ounces of silver short positions. They have exactly 21 days to do it. By January 31st, 2026, HSBC must be completely out of silver. Every short position closed, every derivative settled, every obligation satisfied, or else they face criminal prosecution, regulatory shutdown, and international litigation that could destroy the entire bank. The document revealed that HSBC had convened an emergency board meeting earlier that same day. Every director was present, the chief risk officer, the general counsel, and the head of global markets all gave presentations. They showed the board 3 simultaneous crises that were converging on HSBC like a perfect financial storm. Crisis 1, an allocated silver fraud so massive it defied belief. Crisis 2, an insurance cancellation from Lloyds of London that called HSBC's positions fraudulent. Crisis 3, a legal threat from the People's Republic of China involving state asset theft. After reviewing all 3 crises, the board had no choice. They voted unanimously, exit silver completely, pay whatever it costs, do it in 21 days. Failure is not an option. But here's what made traders' blood run cold when they read this directive. HSBC didn't just outline the exit strategy, they calculated the market impact. They commissioned external risk consultants to model what would happen when HSBC tried to buy 7.3 billion ounces of silver in just 3 weeks. The consultants ran 3 scenarios. Best case scenario, silver reaches $298 per ounce. Median case scenario, silver hits $347 per ounce. Worst case scenario, silver explodes to $534 per ounce. And according to HSBC's own board-approved analysis, the median case is the most probable outcome. That means HSBC's board of directors, the people running one of the world's largest banks, believe silver is going to $347. Not because of speculation, not because of market hype, but because they have to buy 347 million ounces every single day for 21 consecutive days. And there simply isn't enough silver available at current prices to satisfy that demand. Think about what this means. HSBC isn't making a forecast. They're not guessing. They're calculating the mathematical result of their forced buying. When you have to purchase 43 times the normal daily trading volume every single day for 3 straight weeks, the price doesn't just go up, it explodes. The directive laid out the brutal math. Global silver markets trade about 8 million ounces per day. HSBC needs to buy 347 million ounces per day. That's not market activity. That's a market apocalypse, and HSBC knows it. Their own models confirm it. Their board approved it. The exit begins immediately. The price target is locked at $347, and the clock is ticking. 21 days, 7.3 billion ounces, 347 per ounce minimum. This isn't speculation anymore. This is HSBC's official board directive. And when a bank the size of HSBC puts a 347 price target in writing to their own directors and tells them it's unavoidable, smart investors pay attention because HSBC just told the world exactly what's coming, and they start buying today. But the real question is, why is HSBC in such a desperate position? What are these 3 crises that forced them to make this decision? And how did a bank that's been controlling silver for 150 years end up short 7.3 billion ounces with no way out? That's what we need to understand next. What could possibly force one of the world's most powerful banks to abandon a market they've controlled for a century and a half? What kind of pressure makes a financial giant like HSBC willing to lose $211 billion just to escape? The leaked directive revealed 3 catastrophic crises, each one severe enough to destroy the bank on its own. But all 3 hitting simultaneously? That created a nightmare scenario with only one escape route: total exit from silver. Let's start with the crisis that shocked even seasoned banking insiders: the allocated silver fraud. On December 15, 2025, the London Bullion Market Association received complaints from multiple large institutional clients. These weren't small investors. These were sovereign wealth funds, pension managers, corporations with billions in assets, and they all reported the same disturbing problem. Their allocated silver holdings didn't match what HSBC claimed to have in storage. Now, allocated silver isn't like a paper contract or a futures position. It's supposed to be actual physical bars sitting in HSBC's vaults, with specific serial numbers assigned to specific owners. When a client pays for allocated silver, they own those exact bars. Nobody can lend them, lease them, or touch them. They belong exclusively to the client who purchased them. At least, that's how it's supposed to work. HSBC launched an internal audit between December 20th and January 7th. What they discovered was absolutely devastating. HSBC had told clients they owned 380 million ounces of allocated silver. Real bars, real serial numbers, safely stored in HSBC vaults. But when auditors actually went to the vaults and started counting, they found only 47 million ounces. 333 million ounces were missing. Gone. Not misplaced. Not in transit. Not waiting for delivery. Simply gone. The directive revealed exactly what happened to that silver. Between 2015 and 2025, HSBC had been secretly leasing out their clients' allocated silver. They took bars that belonged to pension funds and sovereign wealth managers, and they lent those bars to other financial institutions who needed silver to cover their short positions. The borrowers promised to return the silver eventually, but many of them never did. The bars were sold, shipped overseas, melted down, absorbed into industrial use, and now HSBC's clients wanted their silver back. But HSBC didn't have it. This wasn't a paperwork error or an accounting discrepancy. This was fraud, outright theft of client assets. The LBMA gave HSBC a deadline: January 15th, 2026. Provide documentary proof that all allocated silver exists in the vaults, or face referral to the UK Financial Conduct Authority for criminal investigation. HSBC had 7 days to produce 333 million ounces of silver they didn't possess. That's 41% of annual global silver production. There was absolutely no way to buy that much silver in 1 week without sending prices into the stratosphere. But the allocated fraud wasn't even the worst crisis. The second crisis came from an unexpected source: Lloyds of London. On January 8th, 2026, Lloyds sent HSBC a termination letter. The insurance syndicate that covered HSBC's precious metals operations would not renew their policy. The policy expired on January 31st, 2026, and Lloyds made their reasoning crystal clear in writing. They had reviewed HSBC's silver positions. They concluded that HSBC's reported positions didn't match physical inventory. This suggested either fraudulent reporting or operational failures so massive the positions were simply uninsurable. Lloyds stated they would not provide coverage for positions they believed involved fraud. Without insurance coverage, HSBC's silver positions violated Basel III capital requirements. Banks must carry insurance for derivative exposures exceeding $3 billion. HSBC's silver position was worth $598 billion in notional value. Operating without insurance could result in suspension of their banking license. HSBC had until January 31st to either find new insurance or liquidate everything. But here's the problem. Lloyds of London is the only insurer with capacity to cover positions this enormous, and Lloyds had just publicly called HSBC fraudulent. No other insurance company would touch HSBC's silver book after that. The third crisis made the first two look like minor inconveniences. China entered the picture. Out of the 380 million ounces of allocated silver HSBC had reported to clients, 280 million ounces belonged to Chinese entities, sovereign wealth funds, state-owned enterprises, and the People's Bank of China itself. On January 7th, 2026, Chinese officials contacted HSBC. They wanted physical delivery of all 280 million ounces, shipped to vaults in Shanghai, with the exact serial numbers matching HSBC's allocated records. But HSBC couldn't deliver. Because China's silver had been leased out and was gone, China's response was immediate and terrifying. Failure to deliver constitutes theft of Chinese state assets. China threatened to file suit in the International Court of Justice. They demanded $500 billion in damages. They threatened criminal prosecution of HSBC executives under international law, and they threatened to freeze all HSBC assets in mainland China and Hong Kong. That's $120 billion in deposits and $140 billion in loans. China gave HSBC until January 31st to deliver the silver or face state-level retaliation. 3 crises, all with the same deadline. January 31st, HSBC's board looked at the impossible situation, and they made the only decision that gave them a chance at survival. When HSBC's board of directors stared at the numbers in front of them, they realized something terrifying. This wasn't just a difficult situation, this was mathematically impossible, and yet they had no choice but to try. The directive laid out the cold, brutal arithmetic that would determine HSBC's fate. 7.3 billion ounces of silver. That's what HSBC was short across all their positions. Futures, options, over-the-counter derivatives, and allocated obligations. To exit cleanly, to close every position, and satisfy every obligation, they needed to acquire 7.3 billion ounces in 21 days. HSBC's quantitative analysts ran the numbers. 21 calendar days meant HSBC had to purchase 347 million ounces every single day. No breaks, no holidays, no weekends off. 347 million ounces, day after day after day. But here's where reality became a nightmare. The global silver market, across all exchanges, all dealers, all transactions worldwide, trades an average of 8 million ounces per day. HSBC needed to buy 347 million ounces daily. That's 43 times the entire global daily trading volume. Imagine trying to buy 43 days worth of silver trading in a single day, then doing it again the next day and the next for 3 straight weeks. The market simply couldn't provide that much silver at current prices. It was physically impossible. HSBC hired external risk consultants to model what would happen when they started buying. These weren't optimistic forecasters or silver bulls making wild predictions. These were professional risk analysts using historical volatility data, supply elasticity measurements, and order book depth analysis. They built 3 mathematical scenarios. The best case scenario assumed everything went smoothly. Minimal market disruption, perfect execution, maximum available liquidity. Even in this fantasy scenario, silver reached $298 per ounce. The median case scenario assumed normal market conditions, moderate disruption, typical levels of other traders covering shorts alongside HSBC standard market behavior. In this realistic scenario, silver hit $347 per ounce. The worst case scenario assumed severe disruption. Other major short sellers forced to cover simultaneously, liquidity collapse, panic buying. In this nightmare scenario, silver exploded to $534 per ounce. HSBC's board reviewed all 3 models carefully, and they accepted the median case as the most probable outcome, $347 per ounce. That number appeared throughout the directive, in charts, in tables, in financial projections. It wasn't a hopeful estimate, it was HSBC's official calculation of where silver would be when they finished buying. But the analysts went deeper. They asked a fundamental question. Where would all this silver actually come from? They analyzed every possible supply source on Earth. Mine production over 21 days would generate approximately 46 million ounces. That covered 0.63% of HSBC's needs, utterly insufficient. Silver ETFs globally held about 920 million ounces. If prices rose sharply, Maybe 30% of ETF holders would redeem and sell. That provided 276 million ounces, just 3.78% of what HSBC required, still desperately insufficient. Private investors worldwide owned roughly 1.8 billion ounces. At extreme prices, perhaps 15% might sell. That gave HSBC another 270 million ounces, only 3.7% of their requirement. Industrial users maintained working inventories totaling 280 million ounces. Maybe 40% could be liquidated. If prices spiked high enough, that added 112 million ounces, a mere 1.53% of HSBC's needs. Some governments might sell reserve holdings at elevated prices. Perhaps 80 million ounces could be coaxed onto the market, just 1.1% of the total. The analysts added up every possible source: mine production, ETF redemptions, private sales, industrial inventory, sovereign sales. Total available supply from all sources combined, 784 million ounces. HSBC's requirement, 7.3 billion ounces. The shortfall, 6.5 billion ounces. The math simply didn't work. Even if HSBC bought every single ounce available from every source on the planet, they would still be short 6.5 billion ounces. So the directive outlined a hybrid strategy. HSBC would purchase as much physical silver as possible, up to 800 million ounces, paying up to $400 per ounce if necessary. They would close paper futures and options by buying offsetting contracts, covering roughly 2.8 billion ounces. They would negotiate cash settlements with derivative counterparties willing to accept money instead of physical delivery, settling 1.9 billion ounces. And for allocated silver, they simply couldn't deliver. They would offer clients 150% of market value as damages, paying out cash for 1.8 billion ounces at approximately $450 per ounce. The total cost made seasoned bankers gasp. Silver purchases at an average of $320 per ounce, 256 billion cash settlements at 347 average, 659 billion damage payments at 450, 810 billion gross total, 1.725 trillion. HSBC would liquidate $1.5 trillion in other assets, bonds, stocks, real estate, and loans, everything. They would sell their entire portfolio to raise cash for silver. The net cost to HSBC after liquidating everything else, 211 billion, more than 3 years of profit, gone. But the board approved it unanimously because the alternative was criminal prosecution, Chinese retaliation, and the complete destruction of HSBC. The math was impossible. The cost was catastrophic. But the exit was mandatory, and the 347 target was locked in. However, there was one factor that could make everything even worse. One player who could turn HSBC's nightmare into an absolute catastrophe. And that player was already moving. Intelligence reports reaching HSBC's board revealed something that turned their already desperate situation into a potential catastrophe. China knew, through diplomatic channels and financial intelligence networks, Chinese officials had become aware of HSBC's forced exit, and they were preparing to weaponize that knowledge. The directive contained a chilling section titled People's Bank of China Competitive Buying Risk. HSBC's analysts had discovered that China wasn't just demanding their allocated silver back. They were planning to use HSBC's emergency as a once-in-a-generation opportunity. China's M2 money supply had expanded to an astronomical $51 trillion. Out of that enormous reserve, China had allocated an estimated $30 billion specifically for silver purchases in January and February 2026. At current prices, around $82 per ounce, that $30 billion could buy 365 million ounces. But here's what made HSBC's situation truly nightmarish. China's strategy wasn't to wait for prices to drop. Their strategy was to front-run HSBC's purchases. When HSBC bought, prices would rise. China would buy on the rise. HSBC would buy more, prices would rise higher, China would buy more. This created a feedback loop, a bidding war between a desperate bank with a 21-day deadline and a sovereign nation with effectively unlimited money. HSBC's model showed that if China executed aggressive buying during the exit period, the median price wouldn't stop at $347. It could reach $412. And the worst-case scenario could hit $690. Think about what this means strategically. China holds an estimated 2.1 billion ounces of silver in strategic reserves. At $82 per ounce, those reserves are worth $172 billion. At $347 per ounce, those same reserves become worth $728 billion. At $690 per ounce, China's silver holdings explode to $1.4 trillion in value. By competing with HSBC for every available ounce, China accomplishes 3 objectives simultaneously. First, they drain Western vaults of physical silver at what they consider bargain prices. Second, they massively appreciate the value of silver they already own. Third, They inflict maximum financial damage on a Western banking institution. The directive stated this explicitly. China views HSBC's crisis as a strategic opportunity, and HSBC must assume China will be an active, aggressive buyer throughout the entire 21-day exit period. But China wasn't the only entity positioned to profit from HSBC's disaster. The directive analyzed the broader geopolitical wealth transfer. Russia holds approximately 340 million ounces of silver. India holds around 270 million ounces. Combined, the BRICS nations hold roughly 3.2 billion ounces. At $82 per ounce, those BRICS reserves total $262 billion in value. At $347 per ounce, those reserves surged to $1.1 trillion. That's an $840 billion wealth transfer from Western financial institutions to Eastern governments, the largest single wealth redistribution in modern financial history. And it happens because HSBC made the catastrophic mistake of shorting 7.3 billion ounces of an asset they could never actually deliver. HSBC's board understood the implications completely. By covering their silver short, they were making China, Russia, and India nearly $1 trillion richer. But the board had already made their decision. HSBC's survival was more important than preventing a wealth transfer to the East. The directive laid out the final execution timeline in 3 brutal phases. Phase 1 runs from January 10th through January 15th. Emergency purchases to satisfy the LBMA audit deadline. Target, 50 million ounces of physical silver. Strategy, aggressive spot market buying in London and Zurich. Projected price impact, $82 rising to $115. This phase had already begun. Phase 2 runs from January 16th through January 23rd. Systematic covering of futures and options positions. Target, 250 million ounces of paper contracts closed. Strategy, mass buybacks on COMEX and LBMA exchanges. Projected price impact, $115 surging to $210. Phase 3 runs from January 24th through January 31st. The final desperate push. OTC derivative settlements, damage payments to clients, whatever it takes to close remaining positions. Projected price impact, $210 exploding to $347. That was the roadmap. 21 days, 3 phases, relentless buying every single day. 347 million ounces purchased daily, 43 times normal market volume, and every day the buying continued. The price climbed higher. The directive concluded with a resolution that every HSBC board member signed. The exit is mandatory. The cost of $211 billion must be paid. The 347 price target is accepted as unavoidable. Failure to complete the exit will result in criminal prosecution, regulatory shutdown, and international litigation that could destroy HSBC entirely. Therefore, all necessary measures are authorized. Buy at any price. Settle at any cost. Exit completely by January 31st, 2026. The resolution was adopted by unanimous vote. Every single director voted yes. No abstentions, no objections, no alternatives. The die was cast. HSBC was exiting silver. The London Bullion Market Association's 150-year dominance was ending. The physical silver market was decoupling from paper prices, and the price was going to $347 minimum. For investors holding physical silver, the message was clear. HSBC needs their silver desperately. China is competing to buy the same silver aggressively. The deadline is absolute, the buying is mandatory, and the price target is locked in by HSBC's own board-approved calculations. This isn't speculation anymore. This isn't conspiracy theory. This is a major global bank's official directive to exit a market they can no longer control. The countdown has begun. 21 days, 347 minimum, and possibly much higher if China pushes hard. The war for physical silver just entered its final phase. And HSBC has already admitted they've lost.